Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, November 17th, and I'm recording this from Morgan Stanley headquarters in New York City. One of the bigger upside surprises this year has been the resilient U.S. consumer. Consumption, which makes up about two-thirds of U.S. GDP, has been growing at nearly uninterrupted annual rate of 5 to 6%. And the bullish narrative currently priced into the U.S. equity market assumes that this consumer strength will persist in 2026. We're less certain on this point given the K-shaped economy, which we have written about recently. The top 40% of consumers by income, the top of the K, have been driving 60% of spending. However, it's the mid to lower income households who contribute the bulk of marginal growth in consumption, and they are in fact under pressure. We see at least three headwinds for these consumers. First, cracks are emerging in their credit outlook. In subprime auto lending, 60-day delinquencies are running at 6.7%, the highest since 1994. At the same time, 30-day past due payments on credit cards have climbed to an 11-year high of 5.3%. Meanwhile, credit card balances are growing at 8% per year, twice the annualized pace of disposable income growth, according to household surveys from the Federal Reserve. All of this is occurring as the savings rate has dipped to 4.6%. Second, the narrative of a weakening labor market seems to be building. Although government data has been thin due to the 6-week shutdown, third-party surveys have shown job openings drifting downward to pre-COVID levels and a surge in layoff announcements. Most troubling are the sentiment and anxiety metrics, which have implications for consumer spending. For example, the latest University of Michigan consumer surveys registered the lowest reading for economic conditions in the past 73 years, and the worst readings for employment expectations a year from now since 1980. The third key concern is the lack of affordability, a theme that clearly catalyzed the November elections. The term affordability captures the stress of not only just persistently high prices, but also a stable 3% inflation rate on them. That belies the whack-a-mole pattern of inflation spikes at different times, from eggs to beef to auto insurance to healthcare costs, while trends in gasoline prices and rents have provided a temporary cushion for some. A broadly bullish take on 2026 as a year when stimulus deregulation and Gen AI-linked CapEx produce the rising tide that lifts all the boats cannot become a reality without the mid to lower-end U.S. consumers also re-accelerating. Their marginal propensity to spend is more than 6 times that of the top quintile by income. They matter significantly to aggregate growth in spending and thus to the economy. A K-shaped economy like this demands that investors consider the idiosyncratic risks around the consumer and be very selective in stocks. We suggest rebalancing portfolios for maximum strategic asset allocation diversification. Avoid single stock concentration and take profits in high beta, unprofitable, small and microcap, and speculative names where gains could be vulnerable in 2026. Also consider redeploying to large cap core and quality stocks, including the Mag 7 and Gen AI industry beneficiaries in financials, healthcare, and energy. In fixed income, we're focused on quality and benchmark range duration. International equities and real assets, including gold, real estate, and select private infrastructure, are opportunities for additions. Thanks for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.